The calendar just flipped to a new year, and if you were born before 1966, I want you to sit up and pay attention for the next few minutes, because 5 things about your Social Security check are changing in 2026, and nobody's going to knock on your door to tell you about them. I'm Ryan Parker. I've spent more than 25 years sitting across the table from people exactly like you, helping them figure out when to claim, how to keep more of what they've earned, and how to stop leaving money on the table that was always theirs. And I'll tell you right up front, so you don't spend the whole video waiting for the other shoe to drop. This is not a panic video. Nobody's cutting your benefit. There's no emergency. What there is, and this matters more, is a set of decisions in front of you this year that most people get wrong simply because nobody explained the rules in plain English. So let me be the one who does that, and stick with me to the end, because I've put together a free guide that lays all 5 of these out on a single page you can keep by your desk. I'll tell you how to grab it in a bit. Let's start with the phrase in the title, because it's a little bit of a trick, and I'd rather be honest with you than clever. Born before 1966. That's a nice round marketing bracket. But your Social Security doesn't care about round numbers. It cares about your exact birth year. Here's the real dividing line. If you were born in 1960 or later, your full retirement age, the age at which you get 100% of your benefit, no reduction, is exactly 67. If you were born in 1959, your full retirement age is 66 and 10 months. Born in 1958, 66 and 8 months. And it steps back a couple of months for each year before that. So here's what's actually happening in 2026. The people born in 1960 are the very first group to hit that full 67 mark, and they turn 66 this year, which means the long climb in full retirement age that started back in the 1980s, it finishes now. It's done. 67 is the new normal, and everyone born before 1966 is right in the thick of making claiming decisions under that new normal. That's change number 1, and it's the foundation for everything else. Why does this matter so much? Because your full retirement age is the anchor point for every other number in your Social Security life. Claim before it, and your check is permanently reduced. Claim after it, up to age 70, and you earn delayed retirement credits worth about 8% a year. Your full retirement age is also the exact moment the earnings test disappears, which we'll get to. So the single most important thing you can do this week is find out your precise full retirement age. Not the bracket, the exact age in years and months. You can pull it up in about 90 seconds by logging into your account at ssa.gov. Do not guess on this. I've seen people file 8 months early because they assumed their FRA was 66 when it was actually 66 and 10 months, and that assumption cost them for the rest of their lives. Now here's where the villain of this story quietly walks in. When you go to figure out when to claim, you'll probably run into one of those break-even calculators in dumb. You type in your numbers, it spits out an age, and it tells you the optimal time to file. Here's what almost none of those calculators ask you. How's your health? What's your family history? Is your spouse depending on your check after you're gone? Most of them silently assume you'll live to exactly 90 and treat every dollar the same, whether it lands at 65 or at 95. That's not advice. That's a spreadsheet pretending to know your life. And the reason it's built that way is simple. A generic answer is the one nobody gets blamed for. Keep that in mind every time somebody hands you a rule of thumb. Your full retirement age is a fact. When to claim relative to it is a personal decision, and it belongs to you, all right? Change number 2, and this is the one everyone actually looks forward to. The cost of living adjustment, the COLA. Every year, the Social Security Administration adjusts your benefit to keep up with inflation, and for 2026, that adjustment is 2.8%. So take whatever your check was in 2025, add 2.8%, and that's roughly your new monthly amount starting with your January payment. Let me make that real. If you were collecting, say, $2,000 a month, that raise puts about $56 extra in your pocket every month, a little under $700 over the year. Now, I want to be straight with you because I promised I would. A 2.8% COLA is a modest one. It's not the big 8.7% bump we saw a couple of years back when inflation was screaming. And here's the part nobody says out loud, that raise can get partly eaten by your Medicare Part B premium, which comes straight out of your check before you ever see it. So when you hear COLA, Don't picture a windfall. Picture your benefit holding its ground against rising prices. That's what it's designed to do. Holding ground is the win. And here's a small thing worth knowing. This raise is automatic. You don't apply. You don't call anybody. It just shows up. Which brings me to a gentle warning. Nobody from Social Security is going to phone you about your COLA, ask you to confirm it, or need your bank information to activate it. If someone calls claiming that, hang up. That's a scam, and this time of year, they come out in force. That handles the money coming in, but for a lot of you, there's money still being earned because you're 63, 64, 65, and still working, either full-time or a few days a week to stay sharp. And that leads straight into change number 3, which is one of the most misunderstood rules in the entire system, the earnings test. Here's the deal. If you claim Social Security before your full retirement age and you're still working, there's a limit on how much you can earn before Social Security starts holding back part of your check. For 2026, if you're under full retirement age for the whole year, that limit is $24,180. Earn above it, and they withhold $1 for every $2 you go over. Now, in the specific year you reach your full retirement age, the rules loosen up dramatically. The limit jumps to $65,160, and the penalty softens to $1 held back for every 3 over, and it only counts what you earned in the months before your birthday. And the moment you hit full retirement age, the earnings test vanishes entirely, gone. You can earn $1 million and it won't reduce your check by a dime. Now here is the single most important sentence I'll say about the earnings test, and almost nobody understands it. That money is not lost. It is not a penalty. It is not gone forever. When you reach your full retirement age, Social Security recalculates your benefit and gives you credit for every month they withheld, permanently bumping your check up for the rest of your life. So the earnings test isn't a tax on working. It's a delay, a temporary hold. People here, they'll take part of my Social Security and they quit a job they enjoyed, or they turn down hours thinking they're being robbed. You're not. You're just getting some of it later with interest baked in. I've watched people leave work they loved over a rule they'd completely misread. Don't let that be you. So change 3 is good news dressed up as bad news, and in the higher 2026 limits mean you can earn more before the test even kicks in. Now let's talk about the change that costs people real silent money if they're not watching. Change number 4. This one's about Medicare. Isa des Dewans, Namiskoa, Buns, Sanadloam, and it's called IRMA. That stands for the Income-Related Monthly Adjustment Amount, and here's what it means in plain terms. If your income is above a certain level, you pay a surcharge on top of your regular Medicare Part B and Part D premiums. The higher your income, the higher the surcharge, and it climbs in brackets like stairs. Here's the trap, and I want you to really hear this one. ARMA is based on your income from 2 years prior, so your 2026 Medicare premiums are determined by the income on your 2024 tax return. 2 years back. This catches people completely off guard because they'll do something perfectly reasonable in a given year. Sell a rental property, take a big withdrawal from an IRA, convert some money to a Roth, cash out an old investment, and then 2 years later their Medicare premium jumps and they have no idea why. For 2026, the first IRMA threshold kicks in at $109,000 for a single filer and $218,000 for a married couple filing jointly. Cross that line, even by $1, and you're bumped into a surcharge bracket. It's what we call a cliff. There's no gentle ramp. $1 over $218,000 is a couple, and your premiums go up for the whole year. Here's why I'm telling you now instead of in 2 years. The income that drives your future IRMA is being created right now this year by the choices you make about withdrawals and conversions. If you're anywhere near one of those thresholds, this is exactly the kind of thing worth a conversation before you pull a big chunk out of an account. And if you had a one-time income spike, a home sale, a spouse's passing, retirement itself, you can actually appeal IRMA using a form called SSA 44 for what's called a life-changing event. Most people never file it because they never knew it existed. Now you do. Which brings us to change number 5. And this is a genuinely new one, fresh from recent tax law. And it's good news for a lot of you. It's a new senior tax deduction. Starting with the 2025 tax year and running through 2028, there's an additional deduction available if you're 65 or older. up to $6,000 per qualifying person, or $12,000 for a married couple where both spouses are 65 or older. And this sits on top of your regular standard deduction and the extra standard deduction seniors already get. It's a separate additional amount. Let me tell you plainly what this does and does not do, because there's been a lot of confusing chatter about it. You may have heard Social Security is now tax-free. That's not quite right, and I won't pretend it is. What actually happened is this deduction lowers your taxable income, and for a lot of middle-income retirees, that means the portion of your Social Security that gets taxed drops, sometimes to zero. So the effect for many people feels like tax-free Social Security, even though the mechanism is a deduction, not a change to how benefits are taxed. But, and here's the honest caveat, it phases out at higher incomes. It starts shrinking once your modified adjusted gross income passes $75,000 for a single filer or $150,000 for a married couple, and it disappears completely at higher levels. And it's temporary. Under current law, it's scheduled to end after 2028. So if you're a middle-income retiree, this could knock a real chunk off your tax bill for the next few years. If you're a higher earner, you may get a reduced amount or none at all. Either way, make sure your tax preparer knows about it, because software doesn't always catch it, and it's brand new enough that plenty of people are going to miss it on their return entirely. Now step back with me for a second, because I want you to see how these 5 pieces connect. Because that's the part nobody puts together for you. Your full retirement age decides when your check is safe from the earnings test. Your claiming decision and your COLA set the size of that check. Your withdrawals set your income. Your income sets your IRMA 2 years down the road, and it sets whether you qualify for that new senior deduction. Pull one lever and it moves the others. This is exactly why the generic advice, just claim at 62, just wait till 70, just take the standard deduction, falls apart. Your situation is a system, not a single decision. And that's the real villain here. It's not a cut to your benefits, it's the sheer complexity, layered on year after year, designed so thoroughly that most people just throw up their hands and take whatever the default is. There's no commission for anyone in teaching you. The earnings test gets credited back. There's no fee to be earned telling you to file an SSA 44 form yourself. The system rewards confusion because confused people accept the default. And the default is almost never optimal for you. So let me hand you the clarity. Here is your action plan for 2026, 5 steps in order. Step 1, log into SSA.gov this week and confirm your exact full retirement age in years and months. Not the bracket, the precise number. Step 2, verify your new 2026 benefit amount reflects the 2.8% COLA on your January statement, and ignore anyone who calls claiming they need to activate it. Step 3. If you're working and under full retirement age, write down the earnings limit that applies to you, $24,180 if you're under FRA all year, or the higher $65,160 in the year you reach it. And remember that anything withheld comes back to you later. It is not lost. Step 4. Pull out your 2024 tax return and check your income against the $109,000 single or $218,000 married IRMA thresholds, so nothing surprises you on this year's Medicare premium. And if a one-time event pushed you over, look into the SSA 44 appeal. Step 5. Tell your tax preparer specifically about the new senior deduction, up to $6,000 per person, $12,000 per couple, and confirm whether your income lets you claim it before it phases out. Do those 5 things, and you'll be ahead of the overwhelming majority of people your age who never look under the hood at all. And if you want all of this on one clean page, and every threshold, every limit, the FRA chart by birth year, I've put it into a free guide you can download from the link below. No cost, no catch. It's the same one-pager I hand my own clients, and it lives right by the phone for when a question comes up. Now, I genuinely love to hear from you because it helps me make these more useful. Drop a comment and tell me your birth year and whether you're planning to claim early at your full retirement age or wait. I read them, and I'll try to point you in the right direction where I can. And one more thing before you go. We talked today about when to claim and how much you keep. But there's a decision that sits underneath all of it. one that most married couples get backwards and that can cost a surviving spouse thousands of dollars a year for the rest of their life. It's the survivor benefit and how the higher earner's claiming age quietly protects, or shortchanges, the person left behind. That's what I'm covering next, and if you're married, you do not want to miss it. Take care of yourself. Look at the actual numbers, and I'll see you in the next one. Figures to verify. Current year, full retirement age chart, 1960 plus, SWA the 67, 1959, the 66 White yours 10 mo, 1958, the 66 White yours 8 mo. Verify SSA schedule. 2026, COLA are 2.8%. Verify official SSA announcement. Delayed retirement credit 8% per year. Verify 2026 earnings test limit under FRA, Manda by 24,480. Year reaching FRA limit by 65,160. Verify SSA. Earnings test withholding ratios. $1 per 2 under FRA, $1 per 3 in FRA year. Verify 2026. IRMA of first threshold. $109,000 single and $218,000 married filing jointly. Verify CMS SSA based on 2024 income. New senior deduction up to $6,000 per person, $12,000 per couple, ages 65 plus, tax years 2025-2028. Verify final law. Senior deduction phase out start $75,000 single, $150,000 MFJ May-Guy. Verify SSA 44 form for IRMA life-changing event appeal. Verify current form, name, number. Approximate word count. Toe 540 words. Approximate character count, 14 of 700 characters.